What's the deal with fees? What's the deal with asset-based fees? Hello, and welcome to the first of our series that we're calling What's the Deal? In this series, we will do a deeper dive into financial and investment topics. This presentation today is about fees. Now, to some degree, fees are unavoidable. However, with asset-based fees, as we will see, there are problems. Asset-based fees are weapons of cash destruction because they grow as your portfolio grows. When you invest more money, you pay more fees. When your portfolio grows faster than inflation, you pay more fees. Now, I have not always been so fee conscious, but in March of 2015, there was an article in the British publication, The Economist, about pension and retirement plan reform in the United Kingdom. These new regulations made commissions illegal and capped asset-based fees at 0.75% for retirement plans. This was like a thunderclap for me because in America, fees can be as high as 3% for advisory accounts. There are all sorts of exotic products that commissions can be earned upon, from insurance contracts to mutual funds. And this was really a revolutionary idea. Fees capped at 0.75%, commissions were against the law. And so I wondered, could I revolutionize my practice so that I could meet my clients' needs with a transparent fee structure? So, as I'm prone to do, I made a spreadsheet, which today is the Clear Fee Calculator. The Clear Fee Calculator allowed me to compare two different fee structures side by side. So, looking at the long-term costs and benefits, is there a correlation between fees and performance? There is. And so when we look at these things, you're going to see over time, decoupling your fees from your assets will enhance your portfolio. So what's the deal with fees? We're going to look at three different reports. The first of these is for a professional corporation's 401k. The second is for the partners of this mythical professional corporation. And the third is a very simple report, which compares a $5,000 flat fee to a 1% fee. So with that, I'd like to start and go to the sample professional corporation. So these are the disclosures, and stay tuned. At the end of the performance, we will review these disclosures as well. Overview of fees, but I want to get into the analysis. And so what we're looking at here is that sample professional corporation. They have a balance in their 401k plan of $2 million, annual contributions of $200,000. We're assuming that inflation's 4% and the rate of return is 8%. Tax rate for deductions is 44% because this is a professional corporation. At the margin, taxes are 35%, add state income taxes, and it goes up very quickly. Over here, you can see our two different fee structures. This is an asset-based fee. The client had a bundled product 401k where all of the administration and everything was packaged with this one fee. Participants paid $40 a year. There were 30 participants, and there were no other fees. By removing the asset-based fee, we replaced it with flat fees. So over here, you can see we brought the fund expenses down to 0.2%, with custody and trading with the new custodian coming in at 0.07%. So total asset-based fees are 0.27% compared to 1.25%. The cost per participant went up to $60 from $40, so there was a little increase there. And then we charged a flat $15,000 fee, $1,250 a month. There was some setup and conversion costs. And then the record keeping and accounting for the 401k plan was paid for separately also. And that was $150 a month or $1,800 a year. So going from a percentage to a flat fee, what was the difference? Over a decade, almost $200,000. Over 20 years, our difference is $834,000. And it goes up from there. And quite simply, this is because these fees grow as the portfolio grows, contributions and returns. This fee is assumed to grow at that 4% rate of inflation. So there is an incredibly strong correlation between lower fees and better performance. This has been demonstrated in a number of studies. And so if you went to a flat fee in this situation and everything else was equal, over 20 years, it might mean $1.6 million more for the retirement plan, which isn't bad. And again, this is because that flat fee goes down as your account value goes up. Whereas with the flat fee, it's never going to get any better than this. This was that asset-based charge of 1.25%. So it's always going to be a relatively flat line. The final page looks at the numbers behind it. But I want to shift gears and go to our partners, because it's the partners of the corporation who have to pay for these fees. It's coming out of the corporation's pot, not the plan, not the plan's assets. Same disclosures, same overview, modest changes to the assumption. We said that the partners made up 40% of the plan balance and 50% of the contributions, which that's a reasonable thing. Asset-based fees over here are still the same, but there's only 4 participants, so their annual fee is $160 versus $240, 40 times 4, 60 times 4. These fees stayed the same because they're the ones paying them. So what's it mean to the fiduciaries who are responsible for the plan? Well, after a decade, they've actually paid almost $27,000 less. Over 2 decades between the 4 of them, they've paid over $250,000 less. And again, that correlation between lower fees and higher returns means more money in their retirement, total of $6.1 million versus $5.3 million. And again, even though we started at a much higher place, because it's deductible, because the plan grows with contributions, you can see we start to break even and get ahead very quickly. So how does this work for an individual investor? And again, this is a very simple model, but for the individual investor, same disclosures, same overview. For the individual investor, taxes aren't a factor. With the tax law change in 2018, investment expenses were no longer deductible to individuals. Law is going to change in 2025, so hang on, it may get better. We're just assuming, again, a simple $500,000 account. Asset-based fees are equal. The advisory fee is 1%. The flat fee is $5,000 or 1%. There's a $100 annual account fee. Very basic stuff, nothing exotic. And so we look over 10 years, there's a difference of almost $16,000. Over 20 years, it's closer to 100. And over 30 years, it's over $250,000. And so removing those fees, that's a drag on portfolio performance, all other things being equal. And we can see if this was an account that they were just going to leave alone and go to their heirs, it's another $1 million after 30 years, just by changing the way they pay for their services and advice. Again, that flat fee of $5,000 growing at inflation goes down relative to the 1% advisory fee. It's always going to be 1.2%. Never going to be any better than that. Bringing this to a conclusion, in today's episode of What's the Deal With, we explored how asset-based fees are weapons of cash destruction. To illustrate this, we reviewed 3 hypothetical reports, one for a corporate retirement plan, another for the owner participants of that hypothetical retirement plan, and finally, how a $5,000 flat fee compares to a 1% asset-based fee on a $500,000 portfolio, with everything else being equal. As we saw today, over extended periods of time, the differences are enormous. More gold for your golden years. Consider changing how you pay for your financial services. It may make a huge difference. Again, my name's Doug Richards, and I hope that this presentation has been valuable for you. If this was valuable, please subscribe to our YouTube channel. Thanks again for watching. Thank you for watching this presentation. Please remember Crest Financial LLC for your flat fee collaborative financial planning needs, like corporate retirement plans, foundations and trusts, business succession and executive compensation planning, personal retirement and estate planning, investment planning and portfolio monitoring, and risk management planning. Again, my name is Doug Richards. I can be reached at 541-868-0449 or at doug@crestfinancialllc.com. Thanks.